Hi there, it's Friday the 15th of May 2020. I'm Steve Towers. Welcome to ITB. Let's get started. The OECD hosted a virtual public consultation meeting for the 2020 review of country-by-country reporting under BEPS Action 13. You'll remember that the Action 13 final report in 2015 committed to a 2020 review of the system. The virtual meeting was conducted over 2 days this week. Some of the common themes during the discussion included: should there be public disclosure of the CBC report? Is the existing threshold level, consolidated global revenue of €750 million, too high? How are tax authorities using the information in the CBC reports? Do developing countries have access to the CBC reports? To watch a replay of the virtual meeting, please go to our website or app. The multilateral instrument is, slowly but surely, becoming more relevant to current treaty practice. According to the OECD's website, the MLI has entered into force or will enter into force later this year in 47 jurisdictions. I've identified here the jurisdictions where the entry into force has occurred recently or is scheduled for later this year. 47 jurisdictions means that a very large number of bilateral double tax treaties have been or will soon be impacted. For the latest scorecard from the OECD, please go to our website or app. In India, the tax authorities have issued guidance which provides relief in regard to the resident status of individuals who have been stranded in India due to COVID-19. The guidance does not deal with either the resident status or PE status of companies due to stranded directors or employees. For a copy of the guidance, please go to our website or app. Also in India, the government has issued new income tax rules in regard to the mutual agreement procedure under treaties. For a copy of the new rules, please go to our website or app. And also in India, the Delhi Income Tax Appellate Tribunal has decided a case in regard to the deductibility for income tax purposes of a non-compete fee, an issue on which there have been divergent court decisions in India. The taxpayer company purchased businesses from various vendors. Part of the consideration paid by the taxpayer was in the form of non-compete fees for commitments by the vendors not to disclose confidential information relating to the businesses and for not competing in a similar type of business for 5 years. The tribunal disallowed a deduction for the non-compete fees on the basis that they were capital expenditure. It also held that the fees did not qualify for tax depreciation under Section 32, so no tax relief at all. For a copy of this case, please go to our website or app. And finally, in India, the government has announced a large economic relief package in response to COVID-19. However, in regard to companies, only one item caught my eye. For certain payments to residents, the withholding tax rate will be reduced by 25%. So, for example, if the original withholding tax rate is 20%, the new rate will be 15%. This is effective from the 14th of May 2020 to the 31st of March 2021. For a copy of the Finance Minister's presentation on the package, please go to our website or app. In Malaysia, the authorities in Labuan have made revisions to the territory's economic substance requirements, with retrospective effect from the 1st of January 2019. For a copy of the new requirements, please go to our website or app. Also in Malaysia, the tax authorities have issued guidance in the form of frequently asked questions in regard to the income tax impact of travel restrictions caused by the COVID-19 crisis. The guidance covers the resident status of individuals and companies, the PE status of companies, and cross-border employment income. For a copy of the guidance, please go to our website or app. And also in Malaysia, the government has amended the regulations in regard to service tax on digital services. The key change is that intra-group relief from service tax in regard to both local services and imported services now also applies to digital services. The amendments are effective the 14th of May 2020. For a copy of the amendments, please go to our website or app. In Singapore, the tax authorities have issued updated guidance in regard to the so-called Enhanced Carryback Relief System, which was announced in the 2020 budget. Under that system, the carryback period for unclaimed tax depreciation and tax losses is increased from 1 year to 3 years. For a copy of the updated guidance, please go to our website or app. In Vietnam, the tax authorities have issued guidance in regard to the VAT treatment of letters of credit which are provided by banks. According to the guidance, the provision of letters of credit is subject to standard rate VAT. It is not covered by the VAT exemption for lending. Although the guidance does not indicate its effective date, commentators have noted that some provincial tax departments are applying the guidance with retrospective effect from the 1st of January 2011. Belgium has entered into 2 agreements with each of Germany and the Netherlands in regard to the taxation of cross-border workers in response to COVID-19. For copies of the 2 agreements, please go to our website or app. In the Czech Republic, the government has issued guidance on income tax deductions for R&D expenditure. For a copy of the guidance, please go to our website or app. In Denmark, the National Tax Board has decided a case which concerns the interaction between Articles 8 and 13 of the OECD Model Treaty. The taxpayer is a shipping company which is resident in country X. The board's decision does not identify the specific country. The shipping company operates ships in international traffic. For many years, the shipping company has owned a house in Denmark, which has been used as private accommodation by the shipping company's expatriate director and family. The expatriate director also performs his duties in part in an office in the house. The house is only a short distance from the shipping company's main business premises in Denmark. The shipping company sold the house for a profit. The issue in the case is whether Denmark is permitted to tax that profit under its double tax treaty with X. The relevant provisions of that treaty are the same as in the 2017 OECD Model Treaty. The 3 key provisions are Articles 8.1, 13.1 and 13.3. Let me quickly run through them. Article 8.1 says this: profits of an enterprise of a contracting state from the operation of ships in international traffic shall be taxable only in that state. Article 13.1. Gains derived by a resident of a contracting state from the alienation of immovable property referred to in Article 6 and situated in the other contracting state may be taxed in that other state. And Article 13.3. Gains that an enterprise of a contracting state that operates ships in international traffic derives from the alienation of movable property pertaining to the operation of such ships shall be taxable only in that state. The board accepted that the house was immovable property as referred to in Article 6 and therefore not movable property. That made Article 13.1 relevant and Article 13.3 irrelevant. And so the board was left with the issue of Article 8.1 versus Article 13.1. The shipping company argued that the house is one of its operating assets because it is used as accommodation for the expatriate director and family, and the office in the house is used in part by the director to perform his duties. As it is an operating asset, the profit from the house's sale should be included in the shipping company's profits from the operation of ships in international traffic in Article 8.1. And as Article 8.1 is more specific than Article 13.1, Article 8.1 should apply. In contrast, the Danish tax authorities argue that Article 13.1 applies to profits on the sale of immovable property, even if the immovable property is an operating asset of the taxpayer. And as support, the tax authorities referred to the OECD commentary on Article 13.1, which says Article 13.1 applies also to immovable property forming part of the assets of an enterprise. And the board agreed with the tax authorities, which means that Article 13.1 allows Denmark to tax the profit. For a copy of this case, please go to our website or app. The European Court of Justice has decided a case on referral from Luxembourg. The case concerns Luxembourg's rules on group taxation, and in particular, the different treatment which is given to so-called vertical tax integration and horizontal tax integration. The issue is whether such rules breach the EU's freedom of establishment. The court held that yes, they do. For a copy of this case, please go to our website or app. 2 Advocate General opinions on pending VAT cases have been published by the ECJ. The first opinion is in regard to the Sonicom case. That case concerns the availability of input tax credits for VAT paid on advisory fees which were incurred by a holding company for the purpose of acquiring shares in another company. And the second opinion is in regard to the United Biscuits case. That case concerns whether pension fund management services qualify as VAT-exempt insurance transactions. For a copy of the 2 opinions, please go to our website or app. The European Commission has proposed the deferral of 2 EU tax measures due to COVID-19. Firstly, the Commission has proposed deferring the entry into application of the VAT e-commerce package by 6 months. In other words, from the 1st of January 2021 to the 1st of July 2021. And secondly, the Commission has proposed to defer certain deadlines under the DAC 6 directive by 3 months. However, the Commission emphasises that the beginning of application of DAC 6 will remain the 1st of July 2020, and the reportable arrangements made during the postponement period will have to be reported once the deferral has terminated. For a copy of the Commission's press release on these two proposals, please go to our website or app. In the European Commission's latest infringements package, it has, as usual, identified several tax infringements by member states, which I've summarised here. For a copy of the infringements package, please go to our website or app. In France, the tax authorities have published final guidance on the operation of the interest limitation rules, which were transposed into French law from the EU's ATAD. For a copy of the guidance, please go to our website or app. In Poland, the tax authorities have issued English language guidance in the form of frequently asked questions in regard to APA procedures. For a copy of the guidance, please go to our website or app. In Sweden, the tax authorities have issued guidance in regard to the interest limitation rules. For a copy of the guidance, please go to our website or app. In Switzerland, the Federal Supreme Court has decided a case in regard to interest paid on participatory loans. A Swiss company borrowed money from its former shareholders who were resident in Germany. The loans were described as participatory loans that placed equity-like risk factors with the former shareholders. The loans carried an interest rate of 7% per annum. That interest rate was significantly higher than the maximum interest rate on related party debt, which was notified by annual circulars by the Swiss tax authorities. That meant that the Swiss company had the onus of proving that the 7% interest rate satisfied the arm's length principle. The court held that the Swiss company, despite a number of arguments, failed to prove that point. And fundamental to the court's reasoning was that the Swiss company had failed to establish the business reasons for the loans being participatory in nature. The court said this: neither the tax authorities nor the lower court have ruled out that in the case of a participatory loan, interest rates above the rates notified in the circular can be recognised as business justified. However, this requires that the relevant special circumstances that led to the conclusion of such a loan, and not an ordinary loan, must be set out and proven. However, the Swiss company has neither brought forward nor demonstrated a corresponding factual representation of special circumstances in the entire proceedings. For this reason, it is out of the question, as the Swiss company requests, to consider a risk-related surcharge on the interest rates in accordance with the circulars of the tax authorities for the calculation of the taxable monetary benefit. Now, this might surprise you. The dispute in the case was not in regard to the deductibility of the interest to the Swiss company. Instead, it was whether Swiss withholding tax applied to the interest. And so the consequence of the court's decision was that the excess amount of interest, in other words, the excess of 7% over the maximum rate notified in the circulars, was subject to Swiss withholding tax. For a copy of this case, please go to our website or app. In Algeria, the government has released a draft supplementary finance bill for 2020 as a response to COVID-19. Only one item caught my eye. The withholding tax rate will be increased for foreign companies operating under contracts for the provision of services in Algeria, from 24% to 30%. According to commentators, this change is to incentivize the foreign companies to open offices in Algeria. In Kenya, the 2020 finance bill has been introduced into Parliament. This is different from the Tax Laws Amendment Act 2020, which I've covered in ITB in recent weeks. That act made a number of tax law changes which were said by the government to be in response to COVID-19. Instead, this current finance bill is the regular annual tax revenue legislation. It has two items which caught my eye. The first is the introduction of a 1.5% digital services tax, which appears to have two objectives. Firstly, to levy a DST on non-resident digital service providers. And secondly, to collect income tax from onshore digital service providers who might otherwise not declare the income. For that second objective, the DST is creditable against the income tax liability of a resident person or a non-resident person with a PE in Kenya. I've set out here the key DST provision in the bill. You will see that the income must be derived from or accrue in Kenya through a digital marketplace. You might remember that the 2019 Finance Act inserted a deemed Kenyan source rule and a definition in regard to digital marketplace. Three other points to note in regard to this DST. Firstly, the tax authorities will appoint agents to withhold the tax. Secondly, there are no revenue thresholds with this DST, unlike other countries which have introduced or are proposing to introduce a DST. And thirdly, the DST provision will be included in the Income Tax Act, and therefore I would expect that it will be subject to Kenya's double tax treaties. And the second interesting item in the finance bill is the introduction of a minimum tax, which is set at 1% of gross turnover, and which will apply to certain taxpayers, in particular loss-making companies. For a copy of the bill, please go to our website or app. In Israel, a district court has decided an interesting VAT case concerning the zero rating of export services. A Swiss company within a global group provides representation services to various offshore funds. In order to market those funds to Israeli financial institutions, the Swiss company engaged the taxpayer, an Israeli company within the same group, to liaise with the financial institutions. Importantly, the court characterised the taxpayer's role as going beyond that of a mere selling agent. Its role also included maintaining good relations between the financial institutions and the offshore funds and their managers, and acting as a representative of the offshore funds in Israel and as an address for the financial institutions. Israel's VAT law provides a zero rate for the rendering of a service to a foreign resident. However, it also provides this qualification. A service shall not be deemed to have been rendered to a foreign resident if the subject matter of the agreement is the actual rendering of the service to an Israel resident in Israel, in addition to a foreign resident. Israel's courts have interpreted this qualification as excluding from the zero rate those situations where an Israeli resident is the primary, a secondary, or only a minor service recipient. And in this case, the court decided that such a situation existed here. Standard rate VAT was therefore imposed. For a copy of this case, please go to our website or app. In Saudi Arabia, the government has announced a major increase in the standard rate of VAT from 5% to 15%. The change will be effective the 1st of July 2020. According to a government statement, The change is in response to the significant damage which has been done to the government's revenue position due to both COVID-19 and the fall in oil prices. In the UAE, the government has announced that it will not be following Saudi Arabia's move. The government has no current plans to increase the standard VAT rate. In Canada, the Federal Court of Appeal has decided another GAR case against the tax authorities. This case concerns a so-called Canada-US tower structure which the Bank of Montreal put in place to finance the Harris Group. For a copy of the decision, please go to our website or app. In Peru, the government has published a decree in regard to the carry forward of tax losses. Under the existing law, Peruvian companies can choose to carry forward tax losses under either of two systems. Under System A, losses can be carried forward for 4 years to offset 100% of taxable profits in those years. Whereas under System B, losses can be carried forward indefinitely but can offset only 50% of taxable profits in each year. Well, the decree concerns System A. For tax losses incurred in 2020, the carry forward period is increased to 5 years. For a copy of the decree, please go to our website or app. Also in Peru, the government has published a decree which provides for accelerated tax depreciation. For a copy of the decree, please go to our website or app. In the US, Treasury and the IRS have issued final regulations under Section 385 in regard to the debt versus equity characterisation rules. For a copy of the final regs, please go to our website or app. Also in the US, the IRS has announced certain modifications to APA and MAP procedures. For a copy of the announcement, please go to our website or app. And it's been another slow week for treaty developments. All we've had is one protocol enter into force. I have 2 articles for you this week. The first article is called Federal Supreme Court Denies Beneficial Owner Capacity of a Borrower of Swiss Shares Over a Dividend Payment Date. It's written by Peter Reinars and it's published in the Kluwer International Tax blog. This article describes and analyses the December 2019 decision of the Swiss Federal Supreme Court in regard to the beneficial ownership of dividends which were received under a stock lending agreement which related to shares in Swiss companies between a Luxembourg bank and a related UK bank. The court's decision was that the Luxembourg bank which received the dividends on shares which it had borrowed from the UK bank was not the beneficial owner of the dividends for the purposes of the dividends article in the Luxembourg-Switzerland Treaty. One of the key reasons for the decision was that the Luxembourg bank had a contractual commitment to pay so-called manufactured dividends to the UK bank. The author writes this: the Federal Supreme Court left the question open whether the 2014 update on the OECD Model Tax Treaty commentary was applicable to the case at hand, which concerned dividends arisen in 2009. The Federal Supreme Court concludes that the lower court has implicitly characterised Lux Bank as a mere conduit, which acted only in a fiduciary or administrative capacity with regard to the dividends, and whose contractual obligation to pay a dividend equivalent amount was contingent on the actual receipt of the dividends. And the second article is called Equalization Levy, India's unilateral measure to tax the digital economy. It's written by Pritan Kumar, Vishal Palway and Heta Javeri, and it's published in Bloomberg BNA's Tax Management International Journal. This article gives a good description of the 2% equalisation levy, which is effective from the 1st of April 2020. It also briefly describes the two related income tax changes relating to inbound digital supplies: the significant economic presence rule, which has been deferred to 2021, and the extension of the domestic law source rule. The authors make these comments. Since the G20 OECD discussions on measures to address the tax challenges arising from the digitalisation of the economy still are underway, India has deferred the introduction of the SEP provisions intended to ensure taxation of the digital economy. India has, however, proceeded with the extension of the domestic tax source rule in the context of the digital economy and the introduction of the equalisation levy on e-commerce operators from the 1st of April 2020. It remains to be seen whether India will withdraw the equalisation levy and modify the source rule once global consensus at the G20 OECD level is reached. In the meantime, there will inevitably be some overlap as a result of the interaction between three relatively similar concepts: equalisation levy, extended source rule, and as from the 1st of April 2021, SEP. It will be interesting to see how the Indian tax authorities apply the concepts to the same income, and further clarification is expected. Well, that's the way it is this Friday, the 15th of May 2020. I'm Steve Towers. Have a great weekend.